Inflation is coming in red hot. In this video, we're going to talk about the latest inflation data and why it's so bad for your investment well-being, your financial portfolio. What is going on? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. So let's dive right in to understand what's going on here. So you see inflation making a 40-year high, talking about the consumer price index rising to 8.6%. in May, talking about consumer sentiment falling apart, and you see what's actually going on here. So they do talk about this core year-over-year inflation that sort of strips out things that people need, like, food and energy. Food and energy is, adding up to quite a bit. And this is creating a real problem because you look at this inflation figure of 8.6%, which is an uptick from the most recent data. This is going to cause a lot of concern because you're seeing inflation not just in one category like energy. You're seeing it in energy. You're seeing it in food. You're seeing it goods. You're seeing it in services. And this wasn't just in the last few months. You can't just say, oh, this is Putin's war or something like that. You can see that this problem has been ticking up for quite some time. And that, yes, it did get worsened by the invasion in Ukraine. But arguably, this problem has been ticking up for some time. And so this creates so many challenges. And this is the reason why, stock prices and risk assets are going to continue to come under pressure. Is one, you look at, it's inflation, it's broad-based, it's across a couple of different things. That means it's a challenge to solve this. So not only do you have demand pressure, but you also have supply pressure as well, where you have, effectively sustained underinvestment in certain categories that could lead to high inflation for some time. And so, unfortunately, this is also going to mean that you're going to need to have smart legislators that are, legislators that are going to say, okay, we recognize this is a supply problem. How do we help? Versus say, oh, we'll just muck up the gears and do whatever's on my political agenda. The political agenda is going to quickly shift to how do we break the back of inflation? Oh, that means bringing supply online. Okay, so for energy, you might not like it, folks, but that might mean, drill, baby, drill. And when you read about some of the largest oil producers, even in the U.S., having trouble getting permits to drill, okay, so is that us saying, yeah, we prefer to have $200 oil? And that's the challenge that as a society, the U.S. needs to address right now, of saying what's really the top priority. And ultimately what's going to happen is enough consumers are going to say, wait a second, I can't afford the basic necessities, food, energy, and that's going to effectively lead to a change in Congress, I would personally suspect. So why is this so bad for, risk assets? So one is you see the recent uptick in the recent data. The reason why this is so bad is folks don't know, oh, I thought it previously peaked. Maybe it didn't. Maybe it even goes higher from here. That's a concern. The reason why this is so bad, and this is the key takeaway that I want you to get from this video, is that this gives the Federal Reserve the mandate to do whatever it takes to break inflation. And they really have two main tools that they use. One is raise interest rates, and the other is quantitative tightening, where they're pulling cash out of the system effectively. So both of those do not help. Both of those do not help risk assets, and arguably it takes demand out of, it tries to pull demand out of the economy. So it hurts the economy. So this is the first key point that you need to take away from this is that this gives the Federal Reserve the mandate. The reason why this is so important is even if, let's say, the stock market crashes next week, the Federal Reserve has a mandate to keep going. And many investors who have lived, let's say, from the early 1980s through now have not been through a period where you could have a stock market crash and the Federal Reserve says, tough nuggets, too bad. Because that's effectively what the Federal Reserve has to do right now, or even if the stock market were to collapse 10, 15, maybe even 20% next week, I'm not saying that's going to happen. What I'm saying is if that did, the Federal Reserve still says, unfortunately, inflation's still too high. And that's the challenge for risk assets right now. And that's the reason why, I've made prior videos saying, hey, you should have a plan. What are you going to do if, everyone has a plan until they get punched in the face. I'm saying, hey, imagine you're getting punched in the face. What are you going to do about it? Think about your plan. And that's effectively what's going on with risk assets right now. That's the first key point. The Federal Reserve has that mandate, especially with this inflation data. The second key point, that I want you to, take away from this is that the Federal Reserve, with inflation as high as it is, it increases the odds that you get a recession. What? Why does higher inflation increase the odds that you get a recession? Because the Federal Reserve has the mandate to break inflation. So that means they got to keep doing it. They got to keep doing their, half point increases in interest rates. They got to make sure they're stepping on the pedal with quantitative tightening. Otherwise, you're going to have this sustained problem, and then ultimately it starts leading to significantly higher and higher inflation, or just keeps spiraling until the Federal Reserve breaks it. And so this is the challenge that you have right now, where the odds of a recession are going up because the Federal Reserve has a stronger mandate to break it. And when you have, let's say, a recession, then it's a double whammy for stocks. Not only are you dealing with higher interest rates, which makes risk assets worse, you're now also looking at a picture of lower demand. You're also looking at a picture of lower profit margins. This is just terrible for risk assets. This is terrible not only for the hyper growth unprofitable companies. This is also bad for the profitable slower growth companies, because you're looking at lower profit margins, because you're seeing that inflation that's going to be eating into your profits. And then also the Federal Reserve is going to be taking demand, out of the picture. So then your sales is also going to get hit. So this is the reason why risk assets are coming under pressure, could continue to come under pressure, because two main takeaways. One, the Federal Reserve has a stronger mandate than ever to break the back of inflation. And two, the odds are going up that you get a recession because of this mandate that the Federal Reserve will have to follow in order to break inflation. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. And if you want to follow along with, potentially unrivaled companies that I call out to my exclusive Unrivaled Investing subscribers, check out unrivaledinvesting.com. Thanks so much for tuning in.